Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host Shafiq Morton. As always, it's great to be with you. Over the past month, we said we would do a series on retirement tax reforms. However, some amendments were brought into place and we decided to hold back until Minister Provident Gordon delivered his budget speech in Parliament. During his speech, he announced that compulsory annuity on Provident funds had been held back for 2 years. Earlier this week, I spoke to Hassan, Motala and Neville Erambo about the changes that would be implemented on the pension side, remembering that from the 1st of March 2016, these changes will be implemented. Later on in the show, I'll be chatting to Hugo, Barnard and Yaqoob Osman about Provident funds. Last week, we had a look at the general landscape of the three kinds of pension funds that we get in South Africa, and we had a look at the hotly debated issues surrounding the legislation. In this program, we will take a look at the impact of this legislation on pension and provident funds particularly. Joining me in studio today is Hassan Motala from Wealth Management and Neville Erambo from Oasis Advisory Services. Hassan, assalamu alaikum. Neville, bonjour.
Bonjour, Shafiq.
Neville, there seems to be an indication in this legislation that there could be different applications, for example, to pension and provident funds. Tell us what you know about this.
Yes, Shafiq. Last week, to set the scenes for the retirement tax fund reforms and the changes that it's going to bring to the South African retirement fund landscape, a lot was discussed and there was a lot of information that was brought by them. However, I would like to summarize 5 points based on the pension funds. Number one, your employer's contribution to your pension fund is not considered as a fringe benefit, meaning that you cannot deduct, you cannot reduce from your gross income in order to reduce your tax liability, to reduce the amount that you pay the taxman. The second one, deduction that you make as contribution towards your pension is only limited to the higher of 7.5% of remuneration or 1,750 rand. But in most cases, the 7.5% has been used because, as you bear with me, Shafiq, 1,750 rand has not really kept pace with inflation over time, and it's as such we can waive that and keep it away. However, what to note here is that deduction is based on total remuneration and not on the taxable income. Point number 3, any contribution that you make that is not allowed as deduction in the current year, it can be rolled over to the next year. And the amount that is rolled over can be added to your contribution on that year in question in order to calculate your deduction. Point number 4, Shafiq. Now, when individuals, they retire, they can get 1/3 out of their retirement savings as a cash lump sum, and 2/3 can be used to purchase a pension annuity, a compulsory annuity. And finally, when they resign, you, Shafiq, you resign, and the listeners, they resign and they change job, they can access all their retirement savings up until that point in time, 100% of it. But it is not advisable because it is going to be heavily taxed. As such, they should consider.
Of an example, Hassan, how would the old rules have applied, particularly in terms of a contribution?
Look, it's always good to use an example. Mr. Yusuf Ali. Mr. Yusuf Ali earns income of a basic salary, so annually he earns about 350,000 rands per annum. Then also taking into account that he also gets a travel allowance. You know, look, many people out there do get travel allowances, assuming he gets a travel allowance of 10,000 rands. So now you've got your basic salary 350, you've got your travel allowance of 10,000, so that's 360,000 rands, which is his remuneration. However, also, you know, Mr. Yusuf Ali, over the years, he's been an astute investor. So he puts away a bit of savings and the like. So from these investments that he has been putting away into, he's actually been getting some income from it. You get different forms of income, but he's getting income from his investments, and that amounts to about, say, 40,000 rands per year. So you've got your 350 basic, your 10,000 Rand travel, and he's getting 40,000 Rand from his investments that he has put away. Now, Mr. Yusuf Ali contributes every year towards a pension fund. He contributes firstly 40,000 Rands per year towards his pension fund. But also in addition to this, his employer contributes also 40,000 Rand. So in total, 80,000 Rands, 40 from him, 40,000 Rand is coming from his employer. Now what we got is obviously take that into account and see how does it impact in terms of your remuneration perspective from a taxable perspective. So you've got your 360, for which is your 350 basic, your 10,000 Rand travel. Then you're adding your 40,000 Rand from your income, 400,000 Rand. What is deducted from this year is your pension contribution, or is a expense, is your pension contribution of 40,000 Rands. So that's 400 less your 40. Now we've got to look at it in terms of the rules that we currently have. In terms of the rules, firstly, there's a couple of basic things. Firstly, on the income side, he is allowed an interest exemption of 23,800 Rands. So that first and foremost, he can deduct it from his gross income. That's the 23,800 Rands. Secondly, that pension contribution that is made of 40,000, firstly, that's his pension contribution. In terms of the current limits, as Neville had highlighted, you're allowed 7.5% of your remuneration. Mm-hmm. So 7.5% of what amount? It's of the amount of 358,000. How do we get to 358? So we take the 350 basic, and then of your travel allowance of 10,000, you're allowed only to include in remuneration 80% of that. So that gives you 358, you take 7.5% of that, that gives you an amount of 26,850. Now we know he's contributing 40,000 Rands, he's only allowed 26,850. Neville also highlighted earlier that if you do contribute more, you're allowed to take that excess contribution and roll it over to the next year. So that particular year, he's only allowed to deduct 26,850 Rands. The remaining amount of 13,150, take it over to the next year. So that's in terms of your current rules, is that if you take the deduction of 26,850, you take your 23,800 in terms of your interest exemption. Remember, the employer contribution is not included in your taxable income, so that's kept separately. So in your tax, you're essentially paying total tax of 66,284. That's after taking into account your rebates. So that's under the current rules. And that's obviously important to highlight, because you will see when we look at the new rules, there is definitely some differentiation, and obviously there's an impact in terms of also the potential tax liability that you have.
Which leads to the next question: what happens to Mr. Yusuf Ali once the reforms have taken place?
Right. Now here comes obviously the changes, and we've obviously highlighted some of the basics previously as well. In the new rules, 350 he still earns, so that's still incorporated. 10,000 Rand travel allowance, he still earns, no issues around that. Investment income 40,000, no change around that. Now the changes come. 40,000 Rand that he contributes towards his pension fund, the employer contribution of 40,000 Rands. The employer contribution of 40,000 Rands here is now deemed to be a fringe benefit, and is therefore now included in his taxable income. That's a big difference. Remember, previously the 40,000 nowhere incorporated. Now it's included in the taxable income. So now we've got 80,000 worth of pension deduction that we have. Previously we only focused on the 40,000. Now there's 80,000 worth of pension deduction. Now the new rule states, of your remuneration, you're allowed up to 27.5%. 27.5%. Previously, you were allowed either 1750 or up to 7.5%. Now it's gone up to 27.5%. So it's substantially higher than what was previously allowed. So now if you take that amount, so you got your 358,000 plus 398, which we had previously. Now, so we got the 23,800 that we deducted. Your taxable income now is 416,200 before the deductions. So now, 416,200, you're allowed 27.5% of that. That's a big amount. So if you looked at that amount, it works out to, I think, if 416,200 times 27.5%, your 80,000 is more than compensated, because that amount, it works out to 114,455. You're allowed 80,000. You're looking to take 80,000. So definitely your full 80,000 can't be deducted from that amount. So you take now 416,200 less your 80,000 gives you taxable income now after pension deduction of 336,200. Then, as we did previously, your tax per your tables less your rebate, you're now paying total tax of 62,208. Previously, you were paying an amount of 66,284. So actually now, there's actually a saving, if you can call it that, of about 4,000 rands in terms of tax savings because of the new rules.
So in summary then, Hassan, I can give a greater contribution to a retirement fund, and at the end of the day, I will pay less tax.
As we've got to the new rules, that is the case, Shafiq.
And for this segment, we're going to be talking about Provident funds in particular. We've been having a look at retirement tax reforms. In studio with me, Hugo Barnard, a tax specialist at Oasis, and Yaqoob Osman from the advisory services, his first time on the show. Assalamu alaikum. Good evening, gentlemen. Hugo, let's have a look at the 1st of March 2016. That's up in the headlines. What exactly has happened now in terms of retirement tax reform?
The whole intention behind this retirement fund reform was to create equality across all the different types of retirement funds. Now, National Treasury has achieved most of that. The Minister has announced that all retirement fund reforms, tax reforms, will continue as of 1st of March, apart from the compulsory annuitisation of Provident funds. That they've put out for an additional 2 years. Which now creates a situation where Provident fund members are allowed a deduction for their contributions, but they don't yet have to annuitise that. We'll see how this plays out over the next 2 years, because government has said that if they don't get to where they want to be with complete harmonisation in 2 years' time, they will revisit the retirement fund situation or the Provident fund situation, and they might rethink that deduction. Otherwise, you will find a situation where National Treasury is out of pocket, where they allow the deduction, but there's no recovery through the annuities.
Hugo, what's the background, what's the context to the amendments that Minister Pravin Gordhan mentioned in his budget about holding back compulsory annuity on Provident funds?
The whole intention behind the retirement fund tax reform was to achieve harmonisation across the three different types of retirement funds. One of National Treasury's goals was also to get equality between members in these retirement funds by limiting the total amount that you can deduct during any particular year to 350,000 Rand. That means your lower income earners will now get the benefit of an additional or an increased deduction, but Provident fund members will get a deduction going forward. But your higher income earners, their deduction will be capped at 350,000 Rand. Now, their purpose with that was to achieve fairness and equality across all the retirement funds and all members. Now, what the unions have said is, at present, our members are actually allowed to access our Provident fund savings at the date of retirement. But if you change these rules, they'll no longer be able to access their retirement savings, and to them, it wasn't quite what they were looking for in a Provident fund. So through negotiations between the unions and the Labour constituency and government, they've decided to postpone this so that the members of Provident funds can continue to access their savings. The union's argument is that members should be allowed to spend their retirement savings in the way that they prefer. That's why they went into these funds in the first place. That's why the funds were set up. If you change that now, you're taking away that right.
Yaqoob, let's get to you. Obviously, all of us paying pension funds are very interested in the changes that have come about. In the first part of the show with Hassan and Neville, we spoke about pension funds in particular. How is the client, the customer, how are we going to be affected by the changes in Provident funds?
Shafiq, with regards to Provident funds, the members that are currently in Provident funds are not able to claim a tax deduction against their contributions under the old rules. However, following the implementation of the new rules, they will be able to deduct up to 27.5% of their taxable income or remuneration, whichever is higher. In addition, whatever contributions your employer makes to the Provident Fund will be added to your taxable income, but will be offset by the deduction. In the case of pension funds, the maximum tax annual deduction will be 350,000 Rand.
Now, Yaqoob, it seems as if most of the reforms have been implemented in terms of what we're discussing, but is this the case?
Yes, Shafiq, it is. The additional incentives of the proposed new retirement fund laws have mostly been implemented, and as a result, individuals will be able to decrease the amount of tax they pay by increasing their contributions to a retirement fund. In addition, the way in which pension and provident funds will be treated is more similar now than it was before. However, the part of the reforms that have been postponed for 2 years relates to the need for provident fund members to use 2/3 of their retirement savings to purchase an annuity, which will pay them a pension at retirement. However, it has been stated that if there is no agreement on this, the additional incentives that these members receive as a part of the new laws will no longer apply after this point in time.
Hugo, I think this is an important question. What if I want to exit a particular pension fund, and what happens if I resign now under the current new legislation?
In this regard, the most important thing to say is don't resign your job just to get access to your retirement savings. Jobs are scarce in this country, so whatever you do, that's not the goal. It's not for people to go and resign, and that's one of the points that the unions raised, is their members are now resigning from their retirement funds to access, or their jobs to access their retirement funds. If you do resign for whatever reason, you find a new job, you're changing, these new changes haven't impacted on what the tax consequences on what occurs when you do resign. You can still cash in your retirement savings for whatever reason. However, you must remember that they are taxed, and the tax when you withdraw from a retirement fund is fairly punitive. And unfortunately, most people only realize that when they do get to retirement, because that's actually when these penalties come through in real terms. So net, the current changes don't really change anything with regards to the resignation from a retirement fund.
What happens in the case if somebody retires from a provident fund?
In the event that they retire from a provident fund, presently they can still cash in their retirement funds, their retirement savings, and that grace period has been extended for 2 years. Thereafter, they will, like Yaqoob said, government will revisit that if they cannot get to agreement on the compulsory annuitization.
Yaqoob, anything to add to that?
Yes, Shafiq. Under the new laws, provident fund members will be able to access their full savings at retirement. Government has announced that they will still be able to do this until 1st March 2018. And the maximum tax-free withdrawal will remain at 500,000 less any pre-retirement withdrawals. However, at this point, individuals will need to annuitize up to 2/3 of any new contributions made after 1st March 2018. Let's look at a simple example where Mr. Yusuf Ali is now 50 years old and will be eligible for retirement from his Provident Fund in 2021 when he turns 55. As at 28 February 2018, Mr. Yusuf Ali has 1 million in his Provident Fund, and he remains in the fund until the retirement age of 55. The 1 million will be protected by his vested right, and he will not have to annuitize that portion of his fund. Should the new rules come into effect, he can take up to 1/3 or 70,000 of his 210,000 post 1st March 2018 retirement fund savings in the form of a cash lump sum, and will have to buy an annuity with the other 2/3. However, because the post 1st March 2018 amount is less than the 247,500 minimum, Mr. Yusuf Ali will not have to annuitize any portion of his post 1st March 2018 savings. Effectively, this means that he will be able to access his entire 1,210,000 retirement savings in cash when he retires. If we change the picture just slightly by increasing Mr. Yusuf Ali's retirement savings post 1st March 2018 to 300,000, we will see the impact of the annuitization. The post 1 March 2018 savings is now in excess of the 247,500 limit, which means that compulsory annuitization will kick in. Of course, the 1 million is still protected by the vested rights, so no annuitization will apply to that amount. If Mr. Yusuf Ali elects to take his 1/3 as a cash lump sum, then the remaining 200,000 will be subject to compulsory annuitization.
Yaqoob, what about the case where me as a consumer, I want to transfer from one kind of fund to another. Is this still possible?
With the recent changes to retirement funds, pension fund members cannot transfer their savings to a Provident fund. This was to be implemented within this year. But with the recent amendments, it seems that it will only be possible in 2018 if Provident fund members are obliged to buy an annuity at retirement.
Hugo, as the tax expert, any final words? I mean, what we've discussed seems to be fairly straightforward, but what would your ultimate advice be at the end of the day?
The current changes in the tax law has created a very nice opportunity for members to increase their contributions to retirement savings. In my opinion, retirement savings is still one of the best and most tax efficient ways of savings. Not only is your retirement savings saved from your creditors, but it's also from a tax point of view very beneficial. You get a deduction when you exit that fund at retirement. The tax benefits are very good. The tax rates, the effective tax rate is lower than your marginal tax rate would be. So it is a very good savings and a very good opportunity for members to cash in on this and to contribute additionally to their retirement fund to get that additional deduction.
And just a final question, would this be the perfect path to what we would call financial freedom at the end of the day?
Indeed, indeed. The more people put away for their retirement, the less they have to rely on other people or the state during retirement, and they can settle down and ride into the sunset in financially well-off position.
And on that note, it's time for us to ride off into the darkness. Hugo and Yaqoob, shukran, thank you very much.
Thank you very much.
Many thanks to today's guests, Hassan, Motala, Neville, Erambo, Hugo, Barnard and Yaqoob, Osman. Should you wish to watch this or any of our other shows, tune in to the Oasis Crescent YouTube channel. Should you wish to contact Oasis, 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.